So for many weeks now, we have seen the yen dropping in value. On one hand, this is a good thing. A weaker yen allows Japan to sell more to the world. Japanese goods get cheaper. It is not a surprise that exports from Japan grew by 7.3% in March. If you are outside Japan, especially if you hold dollars, you can buy more for less. It's another reason why tourism has hit an all-time high as well. The issue here is domestic consumption. A lot of Japan's goods, especially food and fuel, are imported from the rest of the world, and these imports are bought using the dollar. As a result, the prices of everything goes up. Japan's real wages tells us the dark side of a collapsing currency. For 23 months now, earnings after adjusting for inflation has been negative, and in February the drop has accelerated, hitting 1.3%. Just imagine working month after month and progressively earning less. Your defense mechanism will kick in. It will be to cut back on spending. You'll tighten your belt and consume less, which is exactly what we are seeing. Japan's household spending has dropped for an entire year, with the worst month hitting 6%. Even with record pay increases, we still have a negative drop in spending in the latest print. This isn't good for Japan's economy. If you can't encourage your population to spend, you'll be hollowed out. You'll be at the mercy of the global consumer. Sooner or later, China will eat Japan's lunch in the exports. And that's why it's paramount for Tokyo to save the Japanese consumer. And the only way to do it is to protect the yen. That's why the BOJ went on an intervention spree. And the intervention is really simple. You sell off your holdings of US dollars in the market and you buy back the yen. You prop up the strength of your domestic currency. In the latest intervention, Japan spent around $23 billion to prop up the yen. The currency appreciated by 3% against the dollar. The dollar went from 158 against the yen down to nearly 153. Now, this is good news for Japan. It helps local inflation come down. But our best friend Janet Yellen wasn't impressed. In fact, it seems that she wasn't consulted on this. Yellen has hit back against Japan's intervention. According to her, the US expects interventions to be rare and for consultations to take place. In other words, Japan has to ask for permission before saving their own currency. Plus, there's also a limit to how many interventions the US Treasury can tolerate. This statement has wrecked confidence in the yen, causing it to trend down again. Future interventions will get tougher now. It will be harder to build confidence in the currency once again. This is not a video about Japan's collapsing yen. It's more about why Yellen is panicking about currency interventions. It really reveals the precarious state of the US economy and how reliant it is on the dollar. Understand what happens during currency interventions. If enough countries dump their dollars, this could crash the strength of the dollar, and this has a whole host of negative effects for the US. And let's talk about inflation first, because it kind of works both ways. A stronger dollar allows the US to import cheaper stuff from the world. It helps bring down the rate of inflation, otherwise known as disinflation. In March this year, the CPI rose by 0.4% month on month. This jacks the overall inflation rate to 3.5%. That's leagues away from the Fed's target of 2%. This prevents the Federal Reserve from lowering interest rates, which is hammering down on the US economy. What Yellen wants is for the US dollar to remain strong to fight inflation without needing the Fed to stay higher for longer. A strong dollar in itself is equivalent to a rate hike without there ever being one. The longer the dollar stays strong, the easier the inflation fight will be. The faster the Fed can bring rates down before the economy implodes. A few days ago, the jobs report came out and it's not looking good. US jobs posted the smallest gain in 6 months. Payrolls rose by only 175,000 jobs. Meanwhile, unemployment rose to 3.9% as well. Wage growth is also a big problem. It grew by only 3.9%, the slowest increase in nearly 3 years. This is a big problem when the US still has an inflation crisis going on. The Fed rate hikes are already crippling the US economy. Borrowing costs are still astoundingly high. When companies can't borrow money at cheap rates and inflation is clobbering consumers, growth is definitely gonna stall. It's not a surprise that unemployment has gone up. There's also another time bomb going on. The US banking sector is at risk of collapse. A week ago, CNBC came out with this shocking headline of why hundreds of US banks may be at risk of failure. Once again, this ties together the risk of staying higher for longer. They analyzed 4,000 banks and came to the conclusion that over 280 are at risk of collapse. Nearly $900 billion in total assets could implode. These assets are tied to commercial real estate and are suffering horrible losses from the rate hikes. We have 265 smaller banks, 16 mid-sized banks, and one big bank with $116 billion in assets at risk. Rates today are higher than even when SVB collapsed, and really let that sink in for a bit. If we get a banking collapse, this will shake the US economy and the world to its core. Trust in the system will take a brutal hit, and this is something that Biden can't afford, especially in an election year. Yellen needs rates to come down soon, and for that to happen, keeping the US dollar strong is in her best interest. It prevents inflation from resurging higher. And let's talk about the elections here, specifically what is leading up to it. A whole lot of spending is needed to keep the gravy train going until November. And that, of course, means the selling of more US debt. Because of the endless wars and the economic fight against China, US spending can't possibly stop. Just in this quarter alone, from April to June, Yellen has to borrow $41 billion more. That's 20% more than her previous estimate of $200 billion. When you flood the market with $40 billion more in bonds, you kind of need to give the market an incentive to buy. There has to be a good reason to purchase the bonds, because if you don't, demand for the debt will be weak and that will push yields higher. That isn't good for the real economy, especially the banking sector. It could cause something in the plumbing to burst. It's a big reason why the dollar has to be kept as strong as possible. It doesn't mean the dollar index has to break all-time highs, but at least stay stronger versus other currencies. This week alone, the US has to sell $125 billion in 3, 10, and 30-year bonds. That is a lot of money flooding into the markets. And if the demand isn't there, there's a real risk of bond yields spiking. That's the last thing Yellen wants. In the latest FOMC meeting, Powell told the world that rate hikes were off the table. That was a bullish signal for US bonds. He essentially told the market that bond values have nowhere else to go but higher. As a result, the traders started buying into US treasuries. That in turn caused yields to fall, and this is good for the US economy. It allows them to delay financial Armageddon. What Yellen needs is another tailwind. She needs to send a signal that inflation is coming down and rate cuts are indeed coming, and that will drive further demand and push yields down lower. And the easiest way to do this is by making the dollar stronger than other currencies. A strong dollar means you can buy more stuff. Investors will invest because it's appreciating, right? And when you have a ton of dollars, where do you park them in? You invest them in US bonds. And that's why Yellen is watching currency interventions today like a hawk. As it stands, the market is still betting on the yen collapsing further. There's around $14 billion betting in the direction of the currency falling to hell, and that is a lot of selling pressure on the yen. Just imagine if Yellen allows Japan to intervene without permission. Suddenly, these short positions could reverse and bet on the yen rising. That in turn will cause the US dollar to fall. And if this momentum turns against the dollar, this could spike inflation higher together with bond yields, not exactly good for the US economy. Now, that's just on the fiscal front. That's just the short term crisis facing Janet Yellen. The long term disaster is the US debt crisis. By now, we kind of know Biden is making the debt worse. The more he spends when rates are higher, the bigger the burden will be. And that's why the dollar has to stay strong for this game to continue. The foreign holdings of US Treasuries have been dropping year after year. It has gone from over 55% to 30% within 15 years. This should be very alarming. Less foreign buying means more capital is needed locally to fund the US government. And this takes money away from the real economy, which further destabilizes companies on Main Street. To attract more foreign buyers, Yellen needs to give the world a reason to hold dollar assets. A stronger reserve currency is a very powerful incentive. The former Treasury head Mnuchin admitted it. A strong dollar is a good thing. It allows the US to finance these very large deficits. Everything today is priced in dollars, so if you're holding greenbacks, the price of everything else drops against it. It's a very simple relationship, but it underpins the entire global financial system. A strong dollar helps finance the US debt at lower interest rates. Now, other countries might experience higher inflation, but at least in America, it's the exact opposite. Inflation goes down. Now, even for countries that manufacture, a stronger dollar is a very big problem. Unless you are flush with cheap commodities like China and Russia, your input costs will rise. One great example is South Korea. Because of the stronger dollar, exporters are feeling the heat. Their input costs are rising because their imported materials are getting more and more expensive. If this goes beyond a certain point, it could impact their exports. The overall price tag could rise. It could counter the export benefits of a falling currency. In other words, demand for their goods could drop. This chart shows us how much intermediate goods countries buy. These are imports that their manufacturers need to make their end products. For example, silicon and rare earths are considered intermediate goods. South Korea buys them from China as raw materials to make their semiconductors. As it stands, over 50% of their imports are intermediate goods. Since everything is priced in dollars, a stronger dollar will mean a higher import bill, and that directly translates into higher manufacturing costs. Other manufacturers like Germany and France also import a ton of intermediate goods. Over 40% are inputs needed to make their exports like cars and airplanes. Conversely, a stronger dollar makes US imports of raw materials cheaper. 38% of American imports are intermediate goods, and this allows them to manufacture cheaper and compete with the other industrial powers like Germany. Once you understand this, it's simple to see why the dollar is a powerful weapon. A strong dollar allows the US to fight inflation and stay competitive at the expense of other countries. And this is simply how the game is played. This is the power of the global reserve currency. This is a big reason why many countries are shifting towards bilateral trade using local currencies. Russia and China, for example, have almost de-dollarized their trade. More than 90% of settlements are carried out in their national currencies, the ruble and the yuan. They don't want to be at the mercy of the system if there's a shortage of dollars. They want to be able to buy and sell their goods without destroying their local currency. This is also happening in the oil markets as well. According to JP Morgan, 20% of global oil last year was bought and sold outside the dollar. That's one fifth of the entire market ditching the dollar in trade. Countries are starting to organize and negotiate with each other to transact bilaterally. While everything is still priced in dollars, this move allows countries to defend against a stronger dollar. At the very least, they don't need to sell their currencies to acquire dollars for global trade. They can simply use the yuan, the rupee, or the Saudi riyal directly. So don't expect Yellen to devalue the dollar willingly. Keeping the reserve currency strong is necessary for the US economy. It actually helps prevent a collapse there. But let me know what you think. Will Yellen allow currency interventions to push the dollar down? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.